we've seen already almost 39 million ounces of silver delivered to COMEX here in the month of October. It'll be one of the biggest ones ever. And what's really interesting about it is that both gold and silver experience, it's a big deal because
What if I told you? The biggest opportunity in decades is quietly forming right now, and almost no one's paying attention. In his latest interview, Andy Schectman, CEO of Miles Franklin, breaks down the truth behind the current gold and silver market moves, the price swings, the manipulation, and what's really coming next. Will silver finally explode past expectations? Will gold break its limits as the dollar weakens and debt piles up? Andy shares eye-opening insights that could completely shift how you see this market, and why the next phase might catch millions off guard. So stay tuned, because if you own gold, silver, or even plan to, this might be the most important update you'll hear all year.
the easy answer would be central banks. Is there coordination here in the West? I don't know. We've become a massive importer of gold. Um, there are so many crumbs out there pointing to gold being reintegrated into the monetary system. Um, could it be the Treasury Department through the Exchange Stabilization Fund? Uh, I don't know. Could it be the realization that the folks in the BRICS nations have been doing this for a very long time, and if we didn't get our act together, um, then what? It was interesting. It's been a several-day pull down, but one of the things that we've seen, according to Michael Lynch, and he does a great job of analyzing the COMEX, is some big buyers, as they drove the paper price down. Let me see if I can give you some actual numbers here. Broke my glasses this morning, so this ought to be fun. But some actual numbers that I think will explain exactly what I'm talking about. But in any case, the big buyers that have come in have been Bank of America and Morgan Stanley. And what's interesting is that you have Morgan Stanley that has publicly, their chief investment officer has come out and said the 60-40 mentality, or excuse me, the 60-40 plan that has always been in place for Wall Street, 60 stock, 40 bonds, should now be 60-20-20. Their chief investment officer is telling you to sell half your bonds and buy gold. Now, they've been a big seller on COMEX for a while. They've bought, 700,000 ounces in October, it looks like. And the other one was Bank of America. Their chief analyst, Michael Hartnett, who has a massively expensive newsletter, has said, no, it should be 25, 25, 25, 25, deviating from the 60-40 rule. Keeping in mind, these banks never recommended gold to their people, 5% at the most. And he's saying 25 stock, bond, short-term treasury, and 25% gold. So they're the big buyers as the price was driven down. What's interesting is that we've seen already almost 39 million ounces of silver delivered to COMEX here in the month of October. It'll be one of the biggest ones ever. And what's really interesting about it is that both gold and silver experience massive mid-delivery month deliveries, issuance. So what I mean by that is that most people who stand for delivery make the intention known on day one of the delivery period, like October 1st. But what we saw in silver, the deliveries are up 193% from the first day notice number. This showing a rush for physical metal as they drive the paper price down using the December contract, and then come in and buy October immediate delivery contracts late in the cycle, which makes it tough to analyze because, most people are looking at the open interest and then try and discern who's going to stand for delivery on day one. Well, these guys come in, knock the paper price down, and come in the middle of the delivery period and buy a contract for immediate delivery. Same thing is true with gold, up 93% from first day notices. And it's a big deal because, you've had 6,000 between October 17th and 19th, believe the 3 days, over 6,000 contracts were written for immediate physical delivery. Each of those were daily records for this point or that point in the delivery period. And so, you're looking at a situation where entities, cover shorts, are driving paper prices down to buy immediate delivery contracts for the current month. All of this is happening, and one could argue is collusive, um, is in I'm sure violation of several laws that the CFTC should be policing. Yet, of course, they're on vacation right now as government is shut down, and it certainly has the footprints of big banks, not only covering shorts, but also big players that are being squeezed out of positions, covering, taking profit. A lot of the things that the public or that the mainstream media would have espoused are valid and true. It was extended, had gone up for 9 straight weeks. It was overbought. But when you see, as an example, last week, a market where after New York had closed and on its way to Asia, there's virtually no liquidity. The traders in New York are done for the day. The traders in Asia are not at their desks. And someone comes and pours billions of dollars of gold and silver on the market. Now, that would guarantee you the least beneficial settlement you could ever possibly get. It would just trigger sell stops all the way down, and you'd get algorithms that would sell as these levels are being violated. There's no one there to catch the bid because there's no liquidity in the market. It would guarantee the worst possible settlement. It was done for effect, and that's when Bank of America and Morgan Stanley came in and bought massive amounts of physical, pushed the price back up like you saw here today. Price goes down and then comes right back up. It reeks of short covering by large players who have too big of a position, these 4 or 8 Western banks, where the rise spike in gold that we saw in silver was creating borderline existential threat to some of these players, and this is the reaction that we should see. I think that's the point, is that the mainstream media talks about the reasons, many of which are valid, but they neglect to notice that part of the way this is done is by drive-by shootings in the most illiquid period of time, where any trader who would have done that, David, would be fired and shot, most likely not in that order, if it were done for real benefit, and it just isn't. So I don't know. The trend hasn't changed. Really, the trend will not change until central banks stop buying gold, and they're not doing it. And this is just a breather. You also have the October sell season, where it's the end of the fiscal calendar. You got hedge funds need to balance their books and book their losses, or their gains. You have November being the buy season, where now they come in with fresh capital, and getting ready to redeploy it. So there's a lot at play here, but in the end, who benefits? The ones that were able to drive the price down and cover stale shorts, that in an environment where we see a lot of standing for delivery, which is an environment that makes having rehypothecated positions very dangerous. We've seen literally billions upon billions upon billions upon billions of dollars in metal delivered to COMEX this year. And we don't know who it is. I mean, could it be Tesla? Could it be Sony or Samsung or Major? And the same thing is true, massive deliveries out of the LBMA. Who's taking it? Are they the photovoltaic crowd, those making solar panels in China? We see a lot of silver coming out of the Shanghai Exchange. Are the industrials, I think is what you're saying, realizing that we are setting up for a battle between the industrials, those who need it to make products, and or the hedge funds and the traders who see that this is a game that is largely, um, oversold, or underowned, and over rehypothecated, meaning that there are far more paper contracts than bars standing behind for delivery, and the trend is for delivery, and they smell opportunity against the naked short positions. How about the military-industrial complex, who needs silver to make high-tech weapons? And really, that to me is why, the why, David, is what really matters. Why would 8 Western banks have been holding the largest concentrated short position in any of the 1,000 commodities traded on COMEX for years? It's because the military-industrial complex, a.k.a. BlackRock, who just happens to be, along with J.P. Morgan, who paid a $920 million fine to the Justice Department for manipulating the metals market, the largest fine at that point the Justice Department ever handed out. they're the primary custodians of the largest silver trust in the world, SLV, and primary of GLD, along with HSBC Bank, who's right there. Excuse me, not HS. Yeah, I believe it is HSBC has a little piece of it. Again, HSBC is right there as well as one of the big short positions that we see in the West. But these are players that have a vested interest to make high-tech weapons. You look at BlackRock; they own all the military manufacturing companies, and they're the ones who are controlling SLV with an 81 million share short position. Now, you can naked short an ETF, creating shares out of thin air that in theory aren't backed by anything. That's why BlackRock came out and said, by the way, there is a risk at some point of those shorts not being able to get the silver. If you short, be careful. Well, they're the ones who are controlling SLV. So if you short SLV, it drives down the paper price. They're the ones who would arguably, if you're thinking military industrial complex, needing lots of silver to make high-tech weapons and F-35s and all that kind of stuff and sell them all around the world, they're also the ones that get the reconstruction contracts when those weapons are used around the world in places like the Ukraine. So it's been in the West's prerogative, not just the United States, but all of the Western countries who, through a strong military, have ruled the world for a very long time. It has been in their best interest to maintain an environment of suppressed silver prices through these exchanges. The thing is that these exchanges offer the ability to stand for delivery. And the countries in the global south and east, the Chinas, the Saudis, the Russians, the Indias, all of the countries that are uniting have become coordinated in many ways, have become motivated in others, sophisticated, wealthy. They weren't when this game began, and so they're standing for delivery. This is creating that imbalance, that potential problem that some of these banks would have. It's beating us at our own game over time. In part that a lot of people who would listen to this and are bright and well-read would say, well, why wouldn't they just come in and buy it all? Well, if you do that, you cut off your nose to spite your face. It's just an environment where it's kind of like the nanny who could steal everything and leave and never come back, or every day take a piece of jewelry and every day take something else, and you wonder, where is all my stuff going? Couldn't possibly be the nanny, could it? They're doing it over time, slowly, to bleed down all of the availability that is there. They want to siphon as much of all of the world's commodities as possible using the delivery mechanisms, and I think the West understands that now, and this is one of these deals where they're fighting back, I think, to kind of keep things from getting a little bit more noticed by the world than they would like in terms of price appreciation.
If this conversation opened your eyes, don't let it stop here. Hit that like button to support the channel, subscribe for more powerful insights from experts like Andy Schectman, and make sure to turn on the bell icon so you never miss an update on gold, silver, and the global economy. Your financial awareness starts right here. Stay tuned. More eye-opening videos are on the way.